Good morning. I'd like to welcome my guest, Naomi Prinz, former Wall Street banker turned journalist, author and speaker. Morning, Naomi.
Good morning.
I've finished reading your book, All the President's Bankers, which I found a fascinating narrative on the relationship, a very almost incestuous relationship between the leading bankers of their day and every president since 1914. Your latest book, Artisans of Money, is something that takes the whole story forward. I had two questions. The first question is, what motivated you to turn from being a successful Wall Street banker, where you could have in fact done the revolving door step and moved into possibly even the White House, to look at the problems and the relationships behind the bankers and Wall Street?
Yes, well, thank you for that. That's a really good question. I'd been on Wall Street and in the City of London for sort of the beginning part of my two careers, the second one being the one that I'm in right now, and the first one being the evolution on Wall Street. And during that time, there was so much going on in the markets. There was so much going on in terms of the position of what an investment bank actually does, how it interacts with people, its political position in the world and markets and so forth, that I was really fortunate to have a very inside seat at what was going on when derivatives were becoming part of the market, when the euro was being discussed and came into being, when Glass-Steagall, which was a major regulation that had come out of the Great Depression in 1933, was repealed in 1999, and up through the mechanisms of Wall Street that had really been altered, that ultimately created the financial crisis of 2007, 2008. So in that position, I been able to have that sort of global view, as well as the very specific analytical ability, and I ran research departments to see how securities were being created and how they impacted the world. And it was my decision when I left that I saw a lot of things changing over that period, and how they were changing was sort of moving away from helping investors and helping the clients of these firms understand what their losses could be if they took a position on, or what their gains could be, but in a way that really showed both sides of the story. That became less prevalent, and it became much more about competition amongst the investment banks and trying to just get clients to basically be fodder or sort of collateral damage for positions that the bank was trying to take. And this was starting, and this was something that really bothered me. I'd always had a bit of a cynical streak and looked at the downside, and it was something that was less and less important from the managerial perspective of these institutions. And certainly when I came to Goldman Sachs, which is the last firm that I worked at, having been in London at Bear Stearns before that, and having quit in 2002 to become someone who could actually explain this to the world. So my choice not to pursue a political career per se was very much predicated on being able to share that objective view from my experience with the world, and give a sort of combination of perspective and on the past and on the future from that ability to sort of be free with what I could say. And often in politics, we don't really consider that as a place where freedom prevails per se. It's much more where spin prevails. So this path has enabled me to do both. I certainly work with politicians. I work with senators. I work with Congress people, as well as central banks and governments and ministries of finance and so forth throughout the world, but in a way where it's more explanatory and able, I think, to hopefully help economies and citizens at the end of the day.
So you actually left Wall Street in 2002, which is a little bit ahead of the crisis that started to brew 2005, 2006, and then obviously exploded. How do you feel that leaving a little bit earlier helped you to see what was going on when you weren't actually there?
So it's interesting because the elements, Wall Street's always a little bit ahead of regulations, and it's really ahead of what citizens ultimately see in terms of the products that it creates and how it makes money, and finding the next new thing to do that with. And when I left Wall Street, it was in the beginning of something called credit derivatives, and these securities, which were packages of other securities called CDOs, or collateralized debt obligations. And Wall Street uses these tricky terms, I think, to keep people a little bit at bay. But what that really means is basically mixing a lot of assets or securities that aren't quite healthy themselves into a new security that has elements of looking like it's healthy or AAA rated or higher quality rated with all this other sort of junky aspect in between. And this was a way that Wall Street was getting rid of a lot of its junk and basically manufacturing something that had some positive qualities, but a lot, obviously, as we saw in the financial crisis of 2007, 2008, that junk still remained, just in a new form. And so when I was leaving, that was very much the main product that was being created throughout London, throughout Wall Street, to manufacture the sort of good, I say in quotation, securities out of bad debt or bad loans or bad securities. And I saw that, and I worked very specifically in the advent of that. And when I wrote my first book after I quit in 2002, it came out in 2004. It was called Other People's Money, The Corporate Mugging of America. So it was very sort of domestically oriented, but it looked at corporate scandals from Enron in the energy sector to a company called WorldCom in the telecom sector, and what the role of banks were, as well as what these new securities and esoteric ways of hiding bad stuff and calling it good stuff. And I wrote about that, and I specifically had a chapter where I spoke about credit derivatives and CDOs as being the potential problem and the thing to look at, because it was going to only cause more harm to the overall markets in the future. And of course, that book came out in 2004, and as you mentioned, the crisis started building and ultimately erupted in 2002, 2007, 2008. So I mean, I saw it because I knew what we were putting into these initial forms of these types of securities and how non-transparent they were and how dangerous they could be, and I wrote about that, and then of course it manifested. I hate to be right about these things, but it manifested in a large financial crisis.
Yeah, that's very interesting. Henry Ford said in the 1930s that if the population really understood just what was going on with their money system, there'd be uproar in the streets the following morning. So in effect, do you feel that what you're doing is actually helping to expose the situation with malfeasance in the banking system in a way that many other people are not prepared to do so?
Yeah, I mean, I like to think so, because it's very easy, you know, as I said before, coining these terms that stand for words that sound very complicated, and I think that's one of the reasons, the idea of complexity and making things more complicated than they need to be is a way that Wall Street can sort of retain its ability to make money on whatever the next new idea that they have is, and to expose that or explain that, whether it's to individuals, you know, such as, you know, your clients and people who want their money managed in a secure, safe sort of way, or it's to governments who should understand that they have a responsibility to their citizens, to the world, depending on how large the country is, to be more prudent with their financial system. I feel that it's sort of my role in life to explain that and to expose that.
And this is where Artisans of Money picks up. It's effectively explaining what the central banks are doing and where they are going, and really the root of their thinking. And that's true.
Yeah, exactly, because as you mentioned in my first book that you've read, that All the President's Bankers was about the relationships between private bankers and public office, the government. So it's basically two poles. And over many, many decades, a lot of those roles and the people that filled them were coming from the same families, whether they were same political families like the Roosevelts or the Kennedys, or whether they were the same banking institutions, the Rockefellers or the Morgans. There's a lot of intermarrying. There was a lot of, you know, sort of handing the position down within institutions like Chase, which became J.P. Morgan Chase, or Citigroup now, which was National City Bank, and all the individuals that were involved, and how they influenced the U.S. government in terms of domestic policy, and more importantly to the world, foreign policy, whether that was into World War I, World War II, and so forth. And along the way, central banks were a component of that, both in Europe, the Bank of England, and Japan, the Bank of Japan, the United States, the Federal Reserve. But they started to have more of an impact, these institutions that kind of hovered between private banks and the governments, and most particularly in the wake of the financial crisis of 2008, and more particularly in the financial crisis of 2007, 2008, they really, particularly from the Fed leading this coordinated effort, took a much bigger role in not just dictating the the cost of money, the interest rate that people pay for money, and the printing, the electronic creation of money, which is a fabrication of money. They also started talking about economic policy and saying that these policies would help the general growth of the population. They started really saying that they had a role that they weren't really equipped to have, but in the process of creating so much money and making the cost of money so cheap, they've really infused artificially the markets in a way that has never happened before. And we are now into almost a decade of that process, where money is cheap, where the central banks just print money in order to buy government debt. So governments feel that they can create more government debt, and corporations feel they can create more corporate debt because the cost of servicing that debt is so low, because central banks have kept rates so low, that there's this whole distortion in the system.
Yes, that's right. And effectively what the central banks are doing, as you rightly say, is supporting the economy to a huge degree. The question that many investors will be wanting to know is, do you think that central banks can get to a normalisation of monetary policy with interest rates back to a reasonable figure where savers can enjoy a reasonable income for a safe investment, without derailing the economy going forward, without putting rates to a position where servicing debt becomes a huge problem and we see all sorts of debt defaults in the future?
Yeah, well, I mean, that's the conundrum that central banks have really put all of us in, because though they say that they're trying to spur the economy, what they've done, in fact, is elevate the levels of debt and artificially elevate the levels of the stock market, because what's happened is investors have had no choice, because they won't get money on their savings because interest rates are so low, and they can't really get money on government bonds or on quality corporate bonds because rates are so low. So what they're doing is being pushed into the stock market. Corporations are basically issuing debt in order to use that money to buy their own stock. So all of this is elevating artificially, not through real growth, one element of the market. And the central banks have kept this going, again, for almost a decade. So the question you ask is really relevant, especially it's very prudent. How do they get out? What's the exit strategy of providing sort of a normal level of interest so savers can get a normal level of growth on their investments and decide how to allocate their assets? If they want some stock and they want some more risk, that's fine. Something more esoteric, that's fine. Bonds or simply savings and cash and getting interest is another element of a good solid asset allocation. But if you're not making money on doing that, all the choices become that much more complicated for the average investor, or even the middle level investor. The problem that exists, though, today is that these central banks, because they've coordinated the cost of money globally, particularly the Fed, the European Central Bank, the Bank of England, the Bank of Japan, effectively the G7, if we're talking in terms of military political terms, central banks have coordinated zero interest rate policy, or in some cases in Europe negative interest rates, or in Japan negative interest rates, where there just is simply no money going to savers, and that has become a problem. If they start to raise rates, as the Fed has started to do in the United States, they've now gone from 0 to 75 basis points between December 2015 and today, that's starting to make the cost of servicing debt a little bit higher. That hasn't caused a major default or major crisis yet in credit, because other central banks, like European Central Bank and Bank of Japan, have come in and kept rates negative. So on average, the cost of money globally is still kind of zero in the major countries. But when it starts to get away from zero is when we will start to see those problems. And we are at a point that's very close to that happening. It's not going to happen tomorrow, but it's one of these things where any given deviation from keeping money at zero is going to cause pain for the bond markets, who have been used to it, and for the stock market, because all of a sudden they'll start to see corporate defaults, and it will be harder for companies to buy their stock and to basically make up for the potential losses that they could have.
Of course, this is only if the central banks in the West and the Federal Reserve do continue with a normalisation of monetary policy and higher interest rates. Yeah. Do you think that Japan holds any signs for where we may be going in the West?
Yeah, so Japan has been really a bit trying to figure out how to deal with what's happening in Asia and what the People's Bank of China is doing, because there is a regional alliance there from trade and a monetary perspective, and also trying to sort of copy and be a partner to the U.S. and to Europe. So what's happened now is that they're more in partner mode than anything else. But that said, they were the central bank that created quantitative easing, or this idea of central banks just printing money electronically to buy government or corporate debt and put money into the market that way, without it being created through any sort of organic means, just artificially. Japan did that in 2001 to 2005 after they had a banking crisis. They just didn't do it as deeply, as globally as what we have now. So they have decided to make their money cheap in the future. So not only are they have negative rates today, or zero interest rates today, but up through 10 years on their yield curve, or the yield on 10-year bonds, or longer term in the future, they're already keeping rates down then too. So if they were the ones who led us into quantitative easing to begin with, they're actually on this path of quantitative easing out the yield curve, so for a longer time. If they continue to do that, and their debt to GDP ratio is much higher than it is in Europe.
It's about 250%, I think.
Right, it's very high. I mean, it's about 100% in the U.S. and a little bit above, and it's a little bit below in Europe. But of course, in Europe, there's a lot of disparities between countries. So in the South, it's much higher. Germany's a little bit lower. But for the most part, you're looking at about 100% debt to GDP, and it's much more in Japan. So if they start to raise rates, they have more debt to worry about that could become more expensive. So they have actually a higher incentive to keep their rates where they are than even the U.S. and Europe would have. So it all becomes messy. The People's Bank of China's rates are a little bit higher because they've decided to opt out of that whole coordination. They've sometimes coordinated, they've sometimes not, but they've done it in a way that they can focus on their own domestic economy properly from the standpoint of the cost of money and inflation and their own growth, and not be coordinated under the auspices of what the Fed had wanted the sort of more G7 central banks to do.
Okay, thank you very much.